going to explain what a dashboard is like, what the information is, so that you can navigate through it and understand where things are coming from and what it means. Without further ado, let's go and look at one that we're going to use as an example. As you can see, first thing, there are three tabs down here, bottom left, trades, positions, and dashboards. Let's start with trades. It's quite self-explanatory. These are all the movements that have happened in this account from the very first day, which is the day that we started recording, is the day that this was funded. All the movements, money movements and companies and buyings and sellings and puts and calls and everything is here. All this information comes directly from Apex. It's downloaded as a CVS and then it's put here as it is, exactly as it is in Apex. The second tab is positions. This is a photograph. In trades, this is a whole movie of everything that has happened so far in the account that we are under consideration, under study. Positions is just a photograph. The day that the dashboard was updated or created, these were the positions in the account of consideration. We have on the left, let me show you here, these first columns on the left that we have more of. These are the calls and puts. We can see it up here, calls and puts. So this is the symbol. This is the AAIS, the day, the put, 65 put, when it expires, the strike, the name of the underlying company, everything is general margin, quantity is the number of contracts. When they are negative, like most of them are, this is a put that, or a call that we would have sold. So this is a sell to open position. When it's positive, like this one, this is a buy to open because it's negative. What else do we have? The price, but this is the price at the moment that the photograph was taken. And the market value, again, is at the moment that the photograph was taken, and the date change as well. All this comes from Apex, from the link where it says positions, and it's just put here. Everything is put here as it is. Now on the right-hand side, we have the shares that we have. This is the name of the company, the quantity, number of shares, the price. Again, this is the photograph. This is the price of the shares at the moment that the photograph was taken, and what the market value of this is at the moment that the photograph was taken. Which, how do you get this? Well, you don't get it because Apex gives it to you, but the market value is the number of shares times the price, and that's it. The date change, yeah, whatever. And the underlying symbol is the ticker symbol. Now, let's go to the dashboard, which is the third tab here. Let's start at the very top, and I'm going to do it orange. Up here, this is the name of the account, which is 5DP, and then three figures, three numbers. Starting date is the date of the first trade, the day that the first trade was placed. Today is the day at which the photograph is taken, and here we can see the number of months that have been traded in this account. This is a number that only accounts for finished months. If we're in the middle of the month, it doesn't count like 5.7 or whatever. It's only when it finishes, then we have the next number up. The next row, let's see what we have here. And I'm going to change the color to blue. Total invested, self-explanatory. How much money was sent to this account? Now, let's go to the right-hand side of all this. This is account value. Account value, again, this comes from Apex. You can see it in your trading account as well at the top right-hand corner in the trading platform where you see account value and you can see buying power. Account value is if you close all the positions that you have at this moment in time, this photography, you would walk out of the account with this money. If you see the total invested in this account is in this case was 1 million, the account value as of today is 1 million point and then $129,569. Therefore, the profit, very simple, is 1.129569 minus the money invested, which is 129,569, which is 13%. Again, this is a photograph. But then we have two other boxes here. One of them says option drag, this one here, and then we say NAV without drag, which is account value without drag. What's this option drag? If all the puts, for these calls don't count, just the puts. If all the puts that we have were put to us as of this moment in time, this photograph, and we turned to the market and sold the shares at the price that they are trading at today, we would be down 281,945. Yeah. I'm going to repeat this concept again. If all the puts that we have sold were exercised as of today, and we went to the market and sold them back to the market, the shares, at the price that they are trading at today, we would be down 281,945. Okay, still the account value is what it is. This hasn't changed. But this is what option drag means. This 281,945, what happens with it? Well, we sold puts this is a line of time. We sold them here, and they are going to expire in 1 month time, 2, 3, 4, 5 months time, whenever it is. As we move, we progress in time, the time value, as we know, goes down. Share price can go up and down, will go up and down actually, but the time value is going to decrease. At the moment of expiration, let's say it's here, you know that we can decide if we are underneath the strike, we can decide whether we want the shares being put to us or we want to roll it forward. And because there's more time value, we can always sell some more time for the same strike, or maybe even a strike below of the one that we are, and roll forward. And because we're selling time, there would always be a positive trade. Okay, we don't need to decide now, but these 281, they need to mature, because over time, all the time value is going to disappear to be zero. And then the intrinsic value, it depends. At the time of expiration, if we're below, we can accept the shares or roll them forward, or let them be put to us and then sell them afterwards and roll them forward. We can do whatever we want. And if they end up above the strike price, we do nothing. We just keep this money, right? And the account value, therefore, the account value without the drag, when this money gets into the account value, when this money matures and gets into the account value as of today would be 1411. So that's what's behind the numbers. Now, next one, I'm going to make it purple. Here we have the positions that we have, the shares that we've bought so far. Have we bought them directly? No, we let the puts be put to us. Ticker is the symbol of the companies that we have. So far, we have 26, I think, 26 positions. And we'll see afterwards how the spread, the asset allocation it is. However, we can see here, industry, that they belong to different industries, okay? Number of shares of each one, self-explanatory. Average open price, again, self-explanatory. These are but anyway, I'm going to comment on this. And this is the price at which we sold the puts. There's 0.1 or 0.2, that's because of the commissions, right? But that's what it is. So we would have sold a put on AL at 35, and then the shares were put to us at 35. BP, we would have sold a put at 24, they were put to us at 24. The income that's here, how come that we have all this income? Well, because AL, we would have sold a put to get put to us, to allow the shares to be put to us, And we've collected all this. If between the moment that the shares were put to us and today calls were sold as well, that money would be here as well. The same for all of them. Price now, again, is a picture when this dashboard was updated. These were the shares, the price of the shares. As of close of business the last day. Cost is how much did we pay for the shares? Well, this is a simple multiplication as you can get, as you can understand. The cost of the shares is, what is it? How many shares do we have? How much do we pay per share? We multiply this one by the other and we get the cost. The value line, same thing, is price now times the number of shares. And that's the value line. The value now. When we add everything together, we have here the money that we have invested in buying the shares. And under the column that says value 9, we have the price of the shares as of the photograph taken today. What can we see? That we have invested 686,288 in buying shares, and today the price has gone down. Why? Again, shares go up and down all the time. We take a picture here, or take a picture here, or take a picture here. Obviously, this number is not going to change because we pay what we paid. This one is going to change every second, every single second. What we have under here is cash. And I'm going to change colors again. We have cash here. And a reminder, invested 1 million. It was not invested in one go. It was invested over time. And we haven't used that million yet because we can see here that there's still 800,000 that we haven't used yet. Look at this. The amount of money spent to invest in the shares is 686, but still we have 801, which is 1.4, 400,000 more than we have invested because we're using the money that we get from the income here to buy shares. So we're having all this money that we're using to buy shares. Now, let me delete this, and now it's clear. Here we have the value line projections. Value line, as you know, gives us estimations for a low and a high in the next 3 to 5 years. The lows and the highs are here, lows and highs, lows and highs. And then the value now and value high could be the value low could be the number of shares that we have now times the low value. Yeah, 1,000 times 40, 40,000, meaning that we paid 35,000 and value line is telling us that these shares are going to trade between 40,000 and 55,000 in the next 3 to 5 years as of today, because the low and the high change as well. And that's why we review the value line reports every 3 months of the companies that we have, right? So that's where it's coming from. If we go to the bottom, we can, and we add everything, we know that out of the investment of 686, if we do nothing, we don't place any trades between 3 and 5 years from today, these shares, good as of the picture of today of the low and the high, they could be trading between 1.1 and 1.8 million. Okay, and that's with the shares that's investing 686. Let's see, a reminder, we still have cash. Let's keep moving down and see what's underneath. The next box that we have here, pink, is a summary of everything that we've seen so far, pretty much. Puts, all the puts that have been sold add up 473. All the calls that have been sold add up to this. The percentages, as you can see, well, are, I mean, mostly is puts. Why? Because this account is very, very young. And at the beginning, we sell puts and puts and puts. And it takes a while to get the full allocation. As you see, we still have 100,000 that we haven't used of cash to buy shares, to complete the allocation, to complete the portfolio. In total options, puts plus calls, we have all the options. Dividends, because the shares have been put to us only recently, we haven't collected that many dividends. These will grow up with time. Margin is, if we use the margin facility that they give us, which is for every dollar, for every dollar, they give us another dollar. But in this case, because we haven't used any margin, they are giving us money actually. Income, the income is everything added up together. The price drag is the difference between what we have invested in the shares and the price that they have now. In our case, is negative because the price of the shares has gone down as of this picture. Margin, nothing has been charged because we haven't used this facility. Bank fees, when the money gets in, they charge you something. Software, if we don't place trades in a month, if you don't place any, we need to place a minimum of, I believe it's 3, but well, we need to place a minimum number of trades not to be charged any software. Statements, if we tick the box in Apex that we want our statements to be received by email, they cost nothing. So the cost when you add them all together, in this case, just like bank fees, because we haven't had any other, we haven't incurred in any other expenses. Right, let's move to the next one. The next one is a breakdown, a breakdown of how much we have been getting per company. So first thing that we have here is the ticker. Look, that there are loads of tickets here and you're not even seeing them all. Let me show them to you. I need to make this smaller. I need to remove this from here to here. Oops. From here to here, this is how many? 88. In this account, we've sold puts on 88 companies, and you can see the tickers in this column. However, not all of them were put to us. Some of them we just kept the money and that was it. How do we know which ones? Look, AL this year was put to us because there's an average open price. If there's no average open price here, that means that we collected some put income, as we can see in this column. AEO, we collected some put income, but the shares were not put to us. In the case of the first one that we have here, AL, we collected this amount of money and the shares were put to us 35, which means that we have already collected per share 647, which is 18%, 18.5% of the price of the average open price. 18% of the average open price has already been collected in put or call income. When it says, when there's more information here, for instance, ANF, it was bought at 12 average open price. It was sold at 11. There was a call, I'm sure. We would be -1. Yeah, because if we buy at 12 and we sell at 11, we will be -1. However, because we collected put income and call income, then we've collected in total the option income was this, but per share, we collected per share 875, meaning that we we were in profit 72.8%, even though we bought them at 12 and sold them at 11, because we collected call income and put income. We're still in profit, and we got 72.83 of the average open price back. Okay, because we got 8.75. So to summarize it, we bought at 12, we sold it at 11, but in income we got 8.75. Right, so even though here we're -1, we still got here 8.75. Therefore, in total, we could be plus 7.75 on an investment of 12, which is 72.8%. I'm going into detail in this one, so because those are the cases that you're going to have anyway. Let's pick another one. What else? Yeah, BlackBerry. BlackBerry, it was put to us at 550, and we've already collected 306 in put income, only in put income, because as we can see here, no call income yet. BKE, we bought them at 1750. We collected call income already, and before we got them put to us, we had collected some put income. In total, how much of this 1751 have we collected? 509, which is 29%, and so on and so forth. Thing is, what I want to grab your attention on is that many companies, all these ones that have nothing here, we just collect the rent, we keep the money, and we never even had the shares, or this one or this one. So it takes a while for a new account to get the shares put to us. Then we start selling call income, but in all cases we get put income to begin with, and with our money we buy more shares. On the right hand side, just to be sure. Yay! Hey, no, I cannot miss this. Current cost to buy shares if all the puts get executed, because we've sold a number of puts. What happens if they get all executed? Well, we would have to buy them all, right? How much would that be? Well, in the case of AL, which is here, no, AEIS, this one, we've sold a put. It hasn't been assigned yet, and it hasn't been, because there's price here. I can tell that this one hasn't expired yet. In the case of AEO, this one, for instance, there's no average price. This share was never put to us. Some put income was received, so we sold the put, but it would cost us nothing to get this put to us because there's no put at the moment. We just sold the puts, expired, worthless, and that was it. So all these ones, all the puts that have a figure on the right hand side under this column here, that means that these puts are active. And remember, if you go to positions, we can see them here. Here we have all the puts that are active at this moment in time. You have to spend 26,000 to buy these ones, 9,400 to buy these ones. These ones are negative, meaning that this is a lead. And we'll talk about leads later on, but this is a lead. So we can sell it back to the market. So adding everything together, we have here that it would, if all the puts got put to us, as of the picture taken now, we would have to invest 1.445 thousand, 1.4 million, okay? But then you see here, estimated cost, 562. And why this difference? Because can all the puts be put to us? In theory, yes. However, this estimated cost is what would happen if everything just have developed as in the first months. And I'm going to tell you what this means. And I will explain that in these next boxes here. Well, the first, this is quite clear, right? Let me change this. This is quite clear. Month 5, that's May, June, July, August, September, blah, 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 of the different years. That's quite obvious and simple and easy to follow. Let me go here to the right-hand side. So this is in this month's monthly, month by month, monthly summary. What has happened? So we have the months here on the left-hand side. So here, first month in May, we started in May. Put income, 100,000. Call income, nothing. We didn't have shares. Options, total. Puts and calls. Dividends, we didn't have shares. Obviously, we don't have dividends. Margin cost is positive because we had money. Therefore, they are giving us an interest. The bank fees is when we send money, no software, no statements. We saw that before. And this is the money in. So on the first month in May, 500,000 were invested. And in August, some other 500,000 were invested. Buy, what it says buy is the money invested to buy shares on the respective months that we have here on the right hand side as well. So that is convenient for us to see it. And this is a breakdown month by month by month. Okay, so this month, this is the money that was invested, and this one and this one. Cost to buy and sell, because in this case, some calls were executed. Cost to buy option shares. Well, we are now, today is the 1st of November. Therefore, if in November, all the puts that we've sold, that we have, remember, in positions here you see that there are puts and calls here. Some of them would expire in November. How do we know that? Because in the ticker, we can see this one is for this one is for January. Look, 2021 01. That's January. Okay. So that's how we know when the shares are due. And then the day, and it's a put, and it's the strike. When we see here 2020 and then an 11, like this one, 2020, and then it says 11, that means that's the 11th month, which is November. When we see, so if all the puts in November were put to us, we would be investing 298. December, January, February, nothing in March in this case, and in April, 1 and 12, as of today again. However, looking at the past, we can see this summary here, which is very interesting. Looking at the past, what has happened in the past? Well, if we get all the puts that we've sold in the past, until today, everything is the past, obviously, we sold a total value of over 2 million, 2.1 million. Meaning that all the puts that we've sold until today, 1st of November, in this case, if all those puts were exercised, we would need 2.1 million to buy all those shares, right? However, what happened in the real life? Many of these puts are not put to us because they expire above the strike. And if they expire above the strike, the option expire worthless and nothing gets put to us, and we get to keep the premium. Some others, what do we do with them? Well, we buy them back, then we sell to open for later on in time. We're just rolling it forward, as we know. How much money have we invested in that? In either in buy to close options, and also there's another concept here, buy to open. This buy to open is buying lids. I'll talk about lids at the end, but know that this is what we have spent, okay? And that's a 38%, 38.95 and 91. Out of this money that we have spent running the business, so to speak, buying things, part of it, this part here, we used it buying shares. And the next figure that we have here, the cost of buying to open and buying to close the puts was 70,000, which is buying lids and buying back options. The figure that we focus on is this one, the 38.91, because this is the cost of, let's say, running the business. And running the business, what is it? First, we sell something. We sell the puts. Let me write it here. We sell puts because it's the bulk. We sell puts for this value. And then out of this value, how much do we actually spend or invested? Well, in total, 827. And we split this in different parts. One is buying to closing these options that we sold to open here. And then what we do is sell to open further down the line. Something else that we do is we buy to open leads. And I'll tell you about that at the end. And something else that we do is buying shares. We saw at the very top that we had bought some shares. This is the cost of running the operation. The more that we move in time, the more accurate this number would be, because it would include the ups and downs of the market. The picture would be years. This cost, if we apply this to what we are supposed to, well, what we're expecting for the months to come, applying this correction, then the money that we would be using would be this. So even though we're committed to this plus this plus this plus this, which if you add it all together is 1.4, we are going to be committed to only to 562. So conservatively speaking, we can expect that for a commitment of 1.4 million, we're actually only going to use 500,000, 562. Okay, in this case. And now at the very end, no, not at the very end, down below here, we have information, more information, and this is the cumulative monthly summary. Up here, we have the monthly, what happens every single month, and we have the months here. What happened in May, what happened in June, what happened in July. Here, what we have is what happened in May, and then this is May and June together, May, June, and July together, from May to August, everything together. Okay, so quite self-explanatory again. Underneath, what we have here, the first graph is, I'm going to go up first to refresh your minds. We have here the cost of buying all the shares, and this is what it is. The value now is a picture of how much the shares are as of the picture taken today. The value low here, the total is, according to value line, these shares that we bought, these stocks, this number of shares, how much are they going to be worth in between 3 and 5 years? Somewhere between this value, the value low, and the value high. That's where this is coming from. But now, oopsie, we're seeing it in a graph, in a histogram. In blue, this is the cost. This is what we have paid for the shares. What's the value now? The picture. And the projections are that these shares are going to be worth somewhere between 1.1 and 1.8 in 3 to 5 years. If we do nothing else, we don't buy any more shares, we don't sell any puts, we don't sell any calls, we don't receive any dividends, and do nothing. And the projections don't change. That's what it could be. That's what the account would look like. And now under here, we have a breakdown per company, which is very useful. Look, this is per company, and the colors are just like those ones, meaning in blue, we have what we pay for them. This is what we pay for LAL. This is what they're worth now, the shares that we have, how much it will be. This is the minimum value according to Value Line that these shares are going to trade at, and this is the maximum. Therefore, when we're close to these tops, we know that chances are that the shares go down, so we can take actions. Yeah, and by looking at these charts now, we know that, well, what's the breaking point when the orangey, like this one, is above this one, we know that we can sell calls. If they are at the money, we will always be in profit. Okay, so this tells us how we are spread out and when we are close to the minimum and the maximum. This pie chart here shows the asset allocation, including the cash. And I'm saying this including the cash because underneath we have one without the cash. These are the different, yep, like this. These are the different here, the different industries, and they are different, yeah, because they are the different industries that the investments have been placed on, which means that we're putting the eggs in different baskets. The more we spread our allocation, the more we invest in different sectors. When one sector goes down, well, some other will be doing good, and that way we're not over. We can see here in this pie chart that we're not over invested in any particular sector. So it's quite the allocation is good, yeah. And the last one is here, which is the account progression. What are we seeing here? This is the money invested in yellow, this one. So it was 500 this month, and then some other 500, and that's what it was invested. Obviously, the profits would have been diluted down when we added money because the money was not working all the time. It was working half of it only for 2 months, and the rest of it for 4. The account value, we can see it in blue. The option income, we can see it here. And this represents, this line, the shares times 5. Forget about this. Obviously, the number of shares is a number, but what we want to see here is the progression, that every time we have more shares. Why? Because we use the money from our option income to buy more shares. And this is it. The last thing that I'm going to talk about slightly is about the leads. We're going to talk about leads, what's called bull put spreads. Let's imagine that we're picking a company that we like, and now we're at the bottom of the third row in a downtrend. And let's say that this is trading at, well, I'll put it here. Well, it goes normally on the right hand side. It's trading at 10. It's trading at 10 right now. We sell a put, 10 put, times, for example, 10 contracts. And that means that our commitment is $10,000. 10 contracts times 100 shares per contract times 10 is 10,000, the commitment. We are exposed 10,000. However, and let's say, just for the sake of argument, let's say that because we sold this put, we've got a premium of 1.60. Just for the sake of argument, okay? We got 1.60 for selling this 10 put. Now, what we do is that we allow the shares to go up a little bit, Because, well, after 3 rolls down, normally they would trade sideways or they would go on an upper trend. The thing is that, let's say that the shares get up here. What happens up here? That the premium is going to be lower. And what we do when the shares get to a high point, and we don't need to determine what high point it is, but we can buy a put. What put are we going to buy? Well, we're going to buy the next put underneath. In this case, it's going to be 9. In some cases, it could be 7.5. It depends on the different top strikes. Let's say that we are going to buy a 9 put. In this case, it's going to be a 9 put. This was a sell to open. And now it's going to be a buy to open because we're buying a put. It's going to be a 9 put. It's going to be the same number of contracts for the same month, obviously. And now if we buy the put, what means is that we can put the shares back to the market. And for that, the market is going to give us 9,000. Therefore, now our exposure is not 10,000 because even if the shares get put to us at 10, we can sell them back at 9. So our exposure 9, now we've reduced it to 1,000 only. The first one we had gotten 1.6, we said, for the sake of argument. And when the shares go up, the premium of the puts goes down. And we have paid for this put, how much? Well, we would have paid 20 cents. Why do I say this? Well, because if we got 1.60, 10% of this, and that's the calculation that we do. We wait for the shares to go up, and when they are high up enough for the puts to cost only 10% of what we received to begin with, and that would be 0.16 cents, we round it up to 20 cents. And that's what we pay. So we place an order to say, buy to open 10 contracts, the same number of contracts of 1 strike less of the same share, of the same company for the same expiration date. And we leave that in the orders. Now what happens? Well, let's imagine now we're blocked. And if the shares get put to us, we will be paying how much? 10, right? We will be paying 10 if we will be paying 10. But we can give them back to the market for 9. And if we add all this together, all this here, what we get is, and I don't want to make it run, so I'm going to use the calculator, is 1.6 that we got before at the beginning, minus the 20 cents that we paid, plus, so no matter what, we're going to walk out with 40 cents profit. 40 cents profit. Okay? So that's how a lead works. What else happens when we buy a lead? Well, we protect our buying power because, as we said before, if all these shares were put to us, the commitment would be 10,000, and then we bring it down to 1,000. Therefore, our buying power is going to increase. And what can we do with our buying power? Well, if it fits, we can sell other put options, and we can make that buying power work for us. So this is, in a nutshell, how a lead works. The last thing that we're going to talk about is what is the price of the dashboard. These dashboards full of information is something that we commission. We don't do this in-house. It's just too complicated. The calculations behind each one of the cells are just crazy. Our lines and lines and lines and lines of programming there. We were told that each one of these dashboards, it would be worth to do it for a price of 200 per dashboard. However, even though you might think that this price is high, what happens is that more informed decisions can be made when you have the information there, when you know when the puts are going to expire, when is a good moment to sell calls without looking, when did I buy this? What was the average open price? How much money have I received in each one of these shares? Would it be like in our sample ANF? We would have never sold that call if we didn't know that we could have walked out of those trades with such a percentage of, what was it, 70 something percent, even though we sold under the money that we had paid for the stock. That kind of decision is easily returned. However, because now we have more and more clients, we've been able to go back to a provider, and the bulk of the work is done. And now it's just tweaks and tweaks, because if you want something else, they would add it. That's no problem whatsoever. So they would say that, okay, because now I have more clients, 50 per dashboard, but monthly, or the monthly ones could make sense. If you want them every 3 months, it could be 80, because there's more. So this would be every 3 months. And some of our clients came back and said, listen, no, I want to take more informed decisions every week, because our accounts are big enough, over 100,000 or 150,000. So I want them every week. And therefore the price would be 20 per week, 1 week. And the dashboards would be delivered the Saturdays or Sunday, or if you want another day, that can be arranged as well. So this could be the prices. And as we say, it's easy to add stuff, and taking informed decisions is quite important. So this money can be made back very easily out of the information that we're getting from the dashboards.